Welcome to PSKY, and thank you for tuning in to another deep dive into the shifting landscape of technology, media, and money. Today's story is all about a studio that has learned to dance with giants and, in the end, decided to merge into one. For years, it was Skydance, an ambitious Hollywood player that rose from a bold idea to co-financing blockbuster films like Mission, Impossible, and Top Gun, Maverick. Now, in the summer of 2025, that name has been folded into something larger, the Paramount Skydance Corporation, a union that could reshape the entire future of global entertainment. This episode isn't just a rundown of corporate paperwork. It's a look at ambition, strategy, and the risks of playing at the top of the streaming and cinema game. We'll trace where Skydance came from, why David Ellison built it the way he did, and what this new merger signals for investors, audiences, and competitors alike. As always, here on PSKY, we use the SWOT method: strengths, weaknesses, opportunities, threats, not as a classroom exercise, but as a narrative lens, a way to see companies in full color rather than black and white. By the end, you'll have a clearer view of whether Paramount Skydance is a rising star worth watching or a studio weighed down by legacy and market pressure. And before we set the stage, a quick reminder: PSKY isn't just a podcast. We're a wider ecosystem of analysis. On YouTube, you'll find a full library of company breakdowns. And on Kindle Unlimited, you can dive into our tech sector investment series books that expand far beyond what we can cover here. If you enjoyed today's episode, consider subscribing, leaving a comment with your own perspective, and checking out the links to our books and Substack dispatches. Every view, read, and share helps keep this project alive. Now, let's pull back the curtain on Skydance. Watch how it vaulted into the spotlight and examine what this new Paramount Skydance era might really mean. Skydance began as a gamble. David Ellison, son of Oracle's Larry Ellison, set out in 2006 to carve a place in Hollywood by marrying big money with bold ambition. His company entered the stage not as a scrappy indie, but as a partner to Paramount Pictures, co-financing blockbusters that would keep cinema seats filled and audiences returning. That ability to tap into legacy franchises became the first and most obvious strength. Mission, Impossible films, Top Gun, Maverick, and a steady stream of action. Driven content cemented Skydance's reputation as a reliable hitmaker. It was a clever move, attaching themselves to brands audiences already trusted, rather than trying to build new icons from scratch. The strength wasn't just in the titles, though. It was in how Skydance structured itself. Few studios were so diversified so quickly. Film, television, animation, gaming, even interactive ventures. By 2017, they were not just a co-financing partner, but a full-scale content engine. Skydance Animation pushed out Luck and Spellbound and had more in the pipeline. Skydance Interactive began work on high-profile gaming projects like Marvel 1943, Rise of Hydra, signaling they weren't content to let Disney or Sony have all the fun. In television, they jumped into docuseries and scripted work that gave them footholds across genres. That blend of diversification meant that when one area slowed, say, the box office during a pandemic, others could pick up the slack. Another strength lay in leadership. Ellison had something rare in Hollywood: patience backed by capital. With family wealth and the support of investors like Redbird Capital, he could build slowly without being forced to sell off pieces too soon. That gave Skydance the freedom to take creative risks and keep long-term control over its portfolio. In an industry often accused of being short-termist, Ellison's approach created stability. And now, the Paramount Skydance merger adds another layer. Skydance didn't just survive as a boutique studio, it absorbed and effectively rescued one of Hollywood's historic titans. Paramount was struggling under debt and streaming pressure, but now, rebranded as Paramount Skydance, Ellison's strengths, the nimble, modern studio structure, the diversified content arms, the strong ties to tech capital, are fused with Paramount's vault of classics, distribution channels, and global recognition. It's rare for a young studio to become the lifeline for an old one, but that's exactly what happened here. In short, the strength of Skydance was never just the films, it was the model, a hybrid of Hollywood legacy and Silicon Valley style strategy. And as Paramount Skydance, that strength now stretches across almost every medium where stories are told. The Paramount deal changed the balance of power in ways that go deeper than just a name swap. Skydance's strength had always been that it wasn't weighed down by the baggage of old Hollywood. It didn't have a century of union disputes, aging infrastructure, or the lumbering bureaucracy that often slowed the legacy studios. It operated lean, with a Silicon Valley mindset. Build fast, pivot when necessary, and let the money follow the audience instead of clinging to outdated traditions. Paramount, by contrast, had become a symbol of that tradition. It carried one of the most iconic logos in the industry, but behind the mountain were piles of debt, fractured management, and a catalogue of streaming strategies that never quite caught fire. Paramount Plus lagged far behind Netflix, Disney Plus, and Amazon Prime, and investors were losing faith. When Skydance stepped in, it wasn't just about rescuing a struggling studio, it was about merging new agility with old weight, hoping the two could balance into something stronger. For David Ellison, this was the culmination of the long game. He had started out as an outsider who bought his way into the Hollywood system, first co-financing Paramount blockbusters in the late 2000s, then gradually building divisions that allowed Skydance to stand alone. By 2020, his company was producing films, games, and animation without needing to lean on Paramount for everything. Yet he never cut the cord, he kept the relationship alive, and when Paramount Global finally faltered, Skydance was ready with capital and strategy to take the reins. The shift is historic because it reverses the usual direction of power. Typically, legacy studios absorb newcomers. Disney buys Pixar, Warner Brothers swallows New Line, Sony buys Crunchyroll. Here, the inverse happened. The newer, nimbler Skydance absorbed the much older Paramount. And because the new entity carries Paramount's name alongside Skydance's Toward, it signals both continuity and change, reassuring audiences that the Paramount brand still matters, while signaling to investors that fresh blood is steering the ship. In terms of strengths, this creates a unique duality. Paramount Skydance now commands both heritage and innovation. It has the brand recognition of a century-old studio with the structure of a modern content machine. That means it can go toe-to-toe with the likes of Disney or Warner Brothers Discovery, but without quite the same financial drag. At least, that's the theory. The challenge, and perhaps the irony, is that strength can sometimes become weakness. The more you inherit, the more you risk being slowed down by it. That's the tension baked into this merger, and it sets us up perfectly to look at where the cracks might already be showing. For all the glamour of the merger and the long list of successes, Paramount Skydance carries weaknesses that are hard to ignore. The first, and most obvious, comes from the very thing that gave it new power: Paramount's legacy. Absorbing a century-old studio means inheriting its debt, its entrenched culture, and its streaming misfires. Paramount Plus has struggled to find its place in the market, always lagging behind Netflix, Disney Plus, and Amazon. And though Skydance brought a sharper vision, it hasn't yet proven it can turn a second-tier streaming service into a global heavyweight. The risk is that Ellison's lean, forward-driven model gets bogged down by the same corporate sprawl that sank Paramount in the first place. Then there's the content portfolio itself. While Skydance's strength has been in attaching itself to legacy franchises, Mission, Impossible, Top Gun, even forays into animated adventure, it highlights a creative weakness too, a reliance on familiar brands rather than cultivating original properties that can stand on their own. In an era when Disney built empires on Pixar and Marvel, and Netflix mined riskier but high-return originals like Stranger Things and Squid Game, Skydance has yet to show the same confidence in raw originality. Investors see the safety of sequels, but they also know that audience fatigue eventually sets in. Animation, once touted as a crown jewel after recruiting former Pixar talent, is another vulnerability. Projects like Luck didn't perform as strongly as hoped. And while Spellbound and others may find niche success, Skydance Animation hasn't cracked the level of cultural penetration achieved by Disney, Pixar, Illumination, or even Netflix's new animated arm. That leaves them spending heavily in a field where giants already dominate, and where returns take years to materialize. There's also the issue of identity. Before the merger, Skydance was the nimble newcomer. After, it risks being perceived as just another big corporate studio. That shift could alienate the very talent and creators who once found Skydance appealing as a flexible, independent alternative. A studio loses its creative edge when it looks too much like the system it once disrupted. And finally, the political baggage. Part of the FCC approval deal required Paramount Skydance to dismantle certain diversity and inclusion programs at CBS News and to install a media bias ombudsman. While that may have satisfied regulators and appealed to certain investors, it also creates reputational risks. In a cultural climate where perception matters as much as profit, being cast as politically compromised or out of step with progressive values could shrink talent pools and audience goodwill. So, for all the strengths of having both heritage and innovation under one roof, the weaknesses show clearly: an over-reliance on old franchises, an underwhelming streaming platform, expensive but underperforming animation bets, and the looming danger of losing its independent identity in the very act of becoming the establishment. The weaknesses tied to streaming and content identity deserve a closer look because they cut to the heart of whether Paramount Skydance can actually function as a modern powerhouse or whether it risks becoming another lumbering relic. Take Paramount Plus. On paper, it's a dual decades of classic Paramount films, Viacom's television library, CBS News, Montana 5, Nickelodeon, even sports through CBS Sports. Yet audiences never flocked to it the way they did to Disney Plus or Netflix. The brand felt scattered. Children's programming, prestige dramas, news clips, and half-hearted originals all fighting for attention under one roof. That lack of a single strong identity was a major weakness before the merger, and now it's Skydance's problem to fix. Ellison has the ambition and perhaps the capital, but not the proven track record in large-scale platform management. Content financing and distribution are different beasts, and building a global subscription model is far harder than co-financing a blockbuster franchise. And about those franchises, another layer of weakness comes from the very strategy that built Skydance's reputation, hitching the company wagon to Mission. Impossible, Top Gun, Terminator, or Tom Clancy adaptations was smart in the short term, but it locks the creative pipeline into familiar grooves. Hollywood has seen this before. New Line once thrived on horror franchises, then collapsed when audiences lost interest. MGM leaned too hard on James Bond and faded until Amazon picked it up. Reliance on existing IP creates short-term stability, but it also risks long-term creative stagnation. If Paramount Skydance can't birth a wholly new cultural phenomenon, something audiences discover fresh rather than revisit nostalgically, its future will always be capped. Animation highlights that point even more starkly. Skydance lured top talent like John Lasseter, formerly of Pixar, in hopes of creating its own animation empire. But Lasseter came with baggage, reputational controversy that dogged the studio's credibility. And the projects themselves, like luck, were polished but failed to connect in the way Disney or Illumination projects do. That's a structural weakness, because animated hits don't just drive box office, they fuel toy lines, spin-offs, and international markets. If Skydance Animation continues to underperform, it becomes a drain rather than a growth engine. And then there's identity, arguably the most fragile weakness of all. Skydance's origin story was compelling precisely because it stood outside the legacy system. A young studio with tech world backing, able to move faster and make bolder bets than Hollywood's dinosaurs. Now, as Paramount Skydance, that narrative collapses. They're not the nimble upstart anymore, they are the system. And with that comes the bureaucratic drag, the politics, the lawsuits, and the expectations of Wall Street. For creatives, it risks making Skydance less attractive. For audiences, it risks making the brand less distinctive. Layered on top is the political baggage of the FCC approval. By agreeing to dismantle DEI efforts at CBS News and install a media bias ombudsman, the new corporation signaled willingness to bend to regulatory and cultural winds. That might win points with certain regulators or conservative investors, but it erodes trust with others. In a talent-driven business, reputation matters. If Paramount Skydance is perceived as politically compromised, it may find some writers, directors, and stars less eager to attach themselves to its projects. So the weakness isn't just financial or creative, it's existential. Skydance built itself on agility, and Paramount lived on legacy. Combining the two risks, creating something that has neither, a company too weighed down to be nimble, yet too young and unproven to wield legacy with the authority of Disney or Warner Brothers, it's a knife edge. And staying balanced on it will define whether this merger becomes a renaissance or a slow collapse. Opportunities are where Paramount Skydance has the chance to prove the merger wasn't just a life raft for Paramount, but a genuine leap forward. And here, the list is long, because in every weakness lies a potential pivot. Start with streaming. Paramount Plus may have lagged, but folding it under Skydance leadership creates an opening to reinvent the platform. Ellison isn't beholden to the old broadcast mentality that shaped CBS and Viacom. He grew up in Silicon Valley, steeped in tech-first thinking. That means Paramount Plus could be reimagined not as a lumbering Me Too service, but as something that leverages Skydance's strengths. Blockbuster tentpoles, cross-media franchises, interactive spin-offs, and a fresh interface that feels built for the next decade, not the last. Imagine Top Gun. Maverick extended into gaming tie-ins via Skydance Interactive, or Mission. Impossible stories that move between series, films, and immersive experiences on a unified platform. If they embrace convergence rather than siloed content, Paramount Plus could finally shed its identity crisis and carve out a distinctive niche in the crowded streaming market. The second opportunity lies in content creation itself. Skydance has leaned heavily on existing IP, but now it sits on a treasure trove of Paramount's library. That's not just sequels, it's the ability to reboot and reimagine properties with fresh creative teams and modern sensibilities. Done right, this could be a goldmine. Think about how Top Gun, Maverick revitalized an old brand, or how Star Trek keeps reinventing itself across decades. With the right balance, Paramount Skydance could turn dusty titles into cultural events. And if they can pair that with one breakout original property, something to rival a Stranger Things or Game of Thrones, it could shift perception from the sequel factory to the innovation studio. Animation, though it stumbled, is still an enormous opportunity. Global demand for family content hasn't slowed, and Disney no longer holds a monopoly on children's imaginations. Netflix, Illumination, and even regional players in Asia have proven that new entrants can capture markets. Skydance Animation has the talent and the funding. What it needs is patience and one defining success. If Spellbound or the upcoming Puku land with audiences, the payoff could stretch across merchandise, theme parks, and global licensing. Ellison knows this, and he has the resources to ride out a few misfires until the formula clicks. Another opportunity is talent recruitment. Hollywood is in flux, with strikes, streaming cutbacks, and a general sense that old studios are lost. Paramount Skydance can pitch itself as a hybrid, big enough to fund ambitious projects, but young enough to still think differently. For directors and showrunners frustrated with the bureaucracy at Disney or Warner Brothers Discovery, that's an attractive prospect. If Ellison positions the studio as a place where creators actually get freedom to experiment, it could lure talent away from competitors. Globally, the opportunity is expansion into markets where Paramount still has brand recognition but weak execution. India, Southeast Asia, Latin America, these are regions hungry for content and less locked into Disney or Netflix ecosystems. With Redbird Capital's financial muscle and Ellison's willingness to experiment, Paramount Skydance could grow internationally faster than the old Paramount ever could. Finally, there's the cultural and political opening. Yes, the FCC concessions around DEI programs created reputational risk, but they also create a chance to reshape CBS News and Paramount's broader media arms in ways that appeal to audiences tired of overtly partisan narratives. If handled with care, Paramount Skydance could position itself as the studio that listens, less combative than Fox, less polarizing than MSNBC, more credible than a struggling CNN. That's a tall order, but in a media environment where trust is scarce, even small gains here could translate into powerful audience loyalty. So the opportunities are clear. Reinvent streaming through convergence, mine and modernize the content library while nurturing originals, push animation until it breaks through, become the talent-friendly studio in a bruised Hollywood, expand globally with tech-backed speed, and use cultural shifts to redefine its news and media voice. The merger doesn't guarantee these outcomes, but it creates the conditions where, with bold strategy, Paramount Skydance could punch far above its current weight. One of the most underappreciated opportunities for Paramount Skydance lies in the physical side of the entertainment business. And here, the conversation inevitably circles back to cinemas. The industry's narrative in recent years has been dominated by the decline of theatrical releases and the rise of streaming. Paramount, like its peers, leaned heavily into that story, treating its own cinema assets as dead weight. That's why Showcase Cinemas, long a stalwart brand under National Amusements, was sold off in the wake of the merger. On paper, it made sense, a distressed asset in a shrinking sector, but in reality, it looks more like a wasted opportunity. Why? Because theatrical isn't dead, it's shifting. Top Gun. Maverick proved that when audiences feel they're getting a cultural event, they show up in droves. The same is true for Barbie and Oppenheimer. Skydance, more than most studios, understood this instinctively. You need spectacles to remind people why the big screen matters. Had Paramount Skydance kept Showcase, it could have experimented with vertical integration in ways that other studios are now regretting abandoning. Imagine a world where Paramount Skydance had its own controlled pipeline, releasing blockbusters on its own screens, bundling streaming subscriptions with cinema tickets, hosting live gaming and esports events powered by Skydance Interactive, or turning Showcase sites into hybrid venues for films, streaming previews, and live events. By selling Showcase, they gave up a testing ground for the very cross-media experiments that could have defined their brand. AMC is burdened with debt, Cineworld is in ruins, and yet the hunger for communal spectacle remains. Whoever cracks the code of turning cinemas into multi-purpose cultural hubs could capture an enormous amount of value. Paramount Skydance was uniquely positioned to try with content, with capital, with a new mandate to innovate. Instead, Showcase slipped away, and with it, a direct line to experimenting with how audiences will gather in the next decade. This is where the contrast with opportunities in streaming becomes sharper. Paramount Plus could be re-engineered into a convergence platform, but without a theatrical arm, that convergence will always be incomplete. Disney still has its own branded theaters through partnerships and controls distribution windows tightly. Netflix, once adamant about avoiding cinemas, has been buying up small boutique theaters for prestige releases because they see the marketing value. Paramount Skydance had a whole chain in its grasp, and rather than transforming it, they treated it like ballast. That was a weakness disguised as a divestment, and a missed chance to lead rather than follow. And that brings us back to the broader opportunities still in play. Yes, Paramount Skydance can modernize its streaming service, reboot its library, and nurture talent. But the truly transformative opportunity to reimagine how content meets audiences in both physical and digital spaces is already partly squandered. Showcase could have been a laboratory for new distribution models. It could have been the place where a Top Gun sequel wasn't just a film, but an event spanning cinema, game, and immersive experience. Instead, that potential has been sold to whoever was willing to take on the bricks and mortar. The irony is that the cinema sector itself may recover faster than expected. As other studios retreat, the supply-demand balance will tighten, and those with their own venues could shape audience habits. Paramount Skydance, having let go of Showcase, will now have to compete for screen space alongside everyone else. For a company that prided itself on thinking like Silicon Valley, controlling the full stack from production to distribution, it's a strangely old-fashioned misstep. So yes, the opportunities are vast. Streaming reinvention, global expansion, animation breakthroughs, and talent magnetism. But there's an unspoken opportunity already slipping past them. In letting Showcase go, Paramount Skydance has traded a chance to experiment with the future of theaters for a short-term balance sheet win. Investors may applaud now, but in 5 years, they may wonder if a laboratory for the next great entertainment experience was quietly sold off for parts. The threats facing Paramount Skydance are formidable, and unlike opportunities, they sit largely outside Ellison's control. The first is the obvious one: competition. Disney, Netflix, Amazon, and Warner Bros. Discovery are all fighting for the same global audience, and each brings distinct advantages. Disney has the world's most profitable IP catalog, from Marvel to Pixar to Star Wars. Netflix commands scale and data. It knows its audience in a way traditional studios can't. Amazon treats Prime Video as a loss leader for retail, meaning it can afford to burn billions on content as a side project. Even Warner, despite its debt, still controls DC and HBO, cultural anchors that guarantee a baseline audience. Against that, Paramount Skydance feels smaller, less entrenched, and more vulnerable to shifts in consumer taste. Streaming saturation itself is another threat. Audiences are exhausted by subscriptions, with churn rates climbing and subscription fatigue now a standard phrase in the industry. The market is crowded, wallets are thinning, and inflation makes every subscription decision more painful. In such an environment, Paramount Plus risks being seen as expendable. If consumers pick 2 or 3 services to keep, it's unlikely many will choose Paramount Plus unless it transforms itself quickly. The box office, while showing flashes of life, is no longer the steady revenue stream it once was. Yes, Top Gun. Maverick and the Barbenheimer phenomenon showed audiences will still show up, but that's the exception, not the rule. Most films, even mid-budget ones, struggle to break even theatrically. For Paramount Skydance, which has leaned heavily on blockbuster tentpoles, that means each failure is financially catastrophic. A single dud in the mission, impossible lineup, could ripple across the whole balance sheet, especially now that the company carries Paramount's debt. Regulation is another looming threat. The merger only passed with conditions, including dismantling DEI programs at CBS News and appointing a media bias ombudsman. That may have satisfied the FCC in the short term, but it leaves the company vulnerable on both sides. Critics on the left see capitulation, while critics on the right may demand even more. In a polarized culture, Paramount Skydance risks becoming a political football, dragged into battles that distract from its core business. Then there's technology disruption. Artificial intelligence, immersive media, and gaming are converging faster than Hollywood can adapt. Audiences, especially younger ones, are spending more hours on Roblox, Fortnite, and TikTok than they are watching films or television shows. Skydance Interactive is a step in the right direction, but it's still nascent compared to what Epic or Tencent are doing. If Paramount Skydance can't pivot into these attention economies quickly, it risks being left behind by a generation that doesn't view movies as the centerpiece of entertainment anymore. Another threat is financial. The merger saddled the new company with the weight of Paramount's obligations. Debt repayments limit agility. Investors may be patient now, because Ellison's reputation and Redbird Capital's involvement provide confidence. But Wall Street has little tolerance for prolonged underperformance. If Paramount Plus continues to lose ground, or if the film slate produces a string of weak openings, the financial markets will turn on the company quickly. That's how studios get carved up and sold for parts. And finally, there's the missed theater opportunity itself. By selling Showcase, Paramount Skydance ceded a lever of control in a moment when physical and digital could have been reimagined together. Theaters may look weak now, but if another studio or even a tech entrant like Apple decides to turn cinemas into cultural hubs with streaming tie-ins, gaming nights, and hybrid releases, Paramount Skydance will be left competing for screen time rather than shaping it. That's a threat they created themselves by walking away from an experiment that could have redefined their identity. So, in short, the threats are everywhere. Entrenched competitors, saturated audiences, fragile box office economics, politicized regulation, disruptive technologies, financial pressure, and the self-inflicted wound of abandoning theaters. For a company that prides itself on strength and agility, the risk is that these outside forces, combined, will chip away faster than any internal strategy can adapt. The scale of the threats becomes clearer when you place Paramount Skydance in the wider history of Hollywood. Almost every major studio that faltered over the last half-century did so not because they lacked hits, but because they failed to manage change. MGM thrived for decades on James Bond, but collapsed when it couldn't adapt to the streaming age. 20th Century Fox, once the studio of Star Wars and Titanic, was absorbed by Disney when its debt piled up and its bets on franchises faltered. Even Warner Brothers, a studio that survived a century, now looks precarious under Discovery, staggering under unsustainable debt. The threat is structural. If you inherit legacy and debt at the wrong moment in a technological cycle, the market will not forgive you. Paramount Skydance walks that knife edge. The streaming war alone could decide their fate. Netflix has turned audience data into a weapon, greenlighting shows with mathematical precision. Disney uses its theme parks, merchandise, and global branding machine to extract value far beyond subscriptions. Amazon can afford to lose billions because Prime Video is just bait for its retail empire. Paramount Skydance has none of those backstops. It must make streaming work as a business in its own right, and that's the hardest position of all. If Paramount Plus stagnates, Wall Street will view the merger not as a rebirth, but as a bailout that failed. The threat here isn't just churn, it's irrelevance. Then there is the cultural battle. The FCC imposed changes to CBS News sound like a bureaucratic footnote, but in practice they place the new company on a fault line of American politics. In an age when news divisions are scrutinized for every editorial decision, having promised regulators a media bias ombudsman is a poisoned chalice. If they enforce neutrality too rigidly, they alienate one side. If they slip, they alienate the other. In a hyper-partisan environment, that's not just reputational risk, it's financial risk, as advertisers shy away and talent migrates to safer homes. Paramount Skydance risks being defined as much by its regulatory compromises as by its creative output. The box office is another soft underbelly. Skydance's model has been blockbuster-driven. Mission, Impossible, Top Gun, Terminator. That means high stakes, high spend, high reward, but also catastrophic downside. A Marvel film that underperforms still benefits from Disney's vast synergy machine. A Netflix misfire disappears in the algorithm, but a Paramount Skydance flop bleeds into debt repayments, investor confidence, and the viability of future tentpoles. It only takes 2 or 3 major disappointments for Wall Street to start circling. The technology shift is arguably the most existential threat. Younger generations are growing up not with film as their central cultural experience, but with gaming, streaming, and short-form platforms like TikTok. For many under 20, a night on Roblox or Fortnite is more compelling than a trip to the cinema. Skydance Interactive gives Paramount Skydance a foothold, but the scale is tiny compared to what Epic, Tencent, or even Microsoft's Xbox ecosystem can command. If the center of gravity in entertainment continues to shift away from film and long-form series, a studio, even a modernized one, risks becoming a secondary player in the attention economy. And then there's the showcase sale, which deserves to be seen not just as a lost opportunity, but as a potential threat. By giving up their own cinema chain, Paramount Skydance place themselves entirely at the mercy of exhibitors. In a world where theatrical space is shrinking, where screens are limited and dominated by whichever studios cut the best deals, they've lost leverage. If Apple or Amazon decide to experiment by buying up cinema chains, something Apple has already toyed with for prestige Oscar campaigns, Paramount Skydance will find itself boxed out of its own distribution pipelines. Selling Showcase may have balanced books today, but it could be tomorrow's bottleneck, leaving them dependent on rivals to reach audiences. Finally, there's the broader threat of perception. Skydance once sold itself as the nimble disruptor, the fresh energy in a tired industry. By merging into Paramount, they now risk being seen as simply another old studio with new paint. In an industry driven as much by narrative as by numbers, that loss of identity could become fatal. If creators don't see Paramount Skydance as different from Disney or Warner, they'll take their projects elsewhere. If audiences don't feel the brand stands for something, they'll scroll past it. If investors don't believe it can grow, they'll divest. And once that perception crystallizes, it's almost impossible to reverse. All told, Paramount Skydance's threats are layered. Competitors with more diversified models, subscription fatigue in a saturated market, political compromise at CBS, dependence on volatile blockbusters, technological disruption, the surrender of theatrical experimentation, and a fragile identity caught between legacy and novelty. The opportunity is immense, but the margin for error is vanishingly thin. Skydance began life as an outsider's bet, a wealthy young producer carving a seat at Hollywood's biggest table. For almost 2 decades, David Ellison proved he could not only play with the giants, but occasionally outmaneuver them by co-financing tentpoles like Mission, Impossible, and Top Gun. Maverick. He built a reputation for reliability in a business where failure is the norm. Then, with Redbird Capital at his side, he pulled off something unprecedented, folding his studio into Paramount, not as a junior partner, but as the force that kept one of Hollywood's most storied names alive. That's the strength of Paramount Skydance today. It has the vaults of Paramount, the agility of Skydance, and the capital to take risks. It can lean on legacy franchises and global distribution, while experimenting in animation, gaming, and streaming. In theory, it has the best of both worlds' heritage and innovation, but strengths always carry shadows. By inheriting Paramount, Skydance also inherited its debts, its streaming failures, and its cultural baggage. Paramount Plus has yet to find a compelling identity. The animation division is still chasing a breakout hit. And selling showcase cinemas may prove to be one of the most short-sighted moves in modern film history. An experiment in distribution left on the table just when audiences were beginning to rediscover the power of theatrical events. Opportunities are real and tangible. Reinvent streaming as convergence. Mine Paramount's catalog while nurturing one new cultural phenomenon. Expand aggressively into markets where Disney and Netflix aren't yet entrenched, and become the studio where bruised Hollywood creatives feel welcome again. If even one of those bets pays off, Paramount Skydance could transform from an underdog merger into a new pillar of global media. Yet the threats press in from all sides. Rivals with deeper pockets, subscription fatigue, volatile box office economics, regulation that turns the company into a political lightning rod, and the broader cultural drift toward gaming and short-form digital entertainment all pull against them. Skydance once stood for nimbleness, Paramount for tradition. Now they must prove they can carry both identities without losing either. So the conclusion is this: Paramount Skydance is a high-wire act. It could be the model for how a nimble studio rescues and modernizes a legacy giant, setting the template for Hollywood's survival in the streaming era. Or it could become the latest cautionary tale of debt, distraction, and missed opportunity, remembered as the studio that sold off its cinemas and let others reimagine the future of audience engagement. At PSKY, we don't just analyze companies, we watch the stories unfolding behind them, because in the end, Wall Street numbers and Hollywood dreams are always connected. This has been our look at Paramount Skydance, from its roots as Skydance Media to its rebirth as a merged titan. If you've enjoyed this breakdown, remember there's more waiting for you. On YouTube, where we take apart the strengths and weaknesses of tech and media stocks week by week, on Substack, where we publish extended dispatches with sources, charts, and context, and on Kindle, where our tech sector investment series dives into entire industries in long-form depth. You've been listening to PSKY.